In the next 18 months, a massive shift is about to happen in global financial markets. $10 trillion will move, and if you're not positioned properly, you'll miss the most predictable wealth transfer in decades. This isn't a future prediction, it's a mathematical certainty, the kind of shift that happens once in a generation. The question is, will you be prepared for it, or will you watch it happen from the sidelines as others capitalize on it? This video isn't about making a guess about what the market might do. This isn't about forecasting the next big crash or bubble. It's about understanding the forces that are set in motion right now. Forces that are mechanical, unavoidable, and already at play. If you can see these forces early, you have the opportunity to position yourself in a way that not only protects your wealth, but potentially grows it. I'm talking about the kind of insight that lets you act before the crowd catches on, positioning you to benefit while others are left scrambling. Today, we're going to dive into the key financial forces that are shaping the world between now and mid-2027. We'll talk about how interest rates, market volatility, inflation trends, and the generational wealth transfer will collide in the next 18 months, and why each one of these forces looks like an opportunity, but contains hidden traps if you don't fully understand the mechanics behind them. The reality is, if you don't grasp the full picture of how these forces are unfolding, you could be on the wrong side of one of the biggest wealth transfers in history. But if you do, you'll be in a position to ride these forces, not be run over by them. The actions of central banks, particularly the Federal Reserve's rate cuts, are reshaping the financial landscape in ways that will impact every investor and saver. The Fed has been cutting rates slowly, and as it does, it's creating a ripple effect across the global markets. One of the most significant consequences of these rate cuts is what happens to the $6 trillion currently sitting in money market funds. These funds, which have been a safe haven for cash, are no longer earning the returns they once did. As rates fall, this $6 trillion is looking for a new home, one that offers a higher return. And as this cash moves, it will impact everything from bonds to real estate to stocks as investors seek out higher-yielding assets. It's the mechanics of money in motion. When you have a massive pool of capital searching for better returns, it shifts asset prices. The question is, where is that money going to flow next? On top of the interest rate environment, there's another massive force that will affect everything. The U.S. Treasury's $9 trillion of debt maturing in the next 18 months. This is a ticking clock that most people aren't paying attention to. The Treasury has to refinance this debt, meaning it will need to issue new bonds to pay off the old ones. This massive refinancing operation is going to create pressure on the bond market and impact interest rates across the board. The more debt the Treasury issues, the higher the yield it will need to offer to attract buyers. This, in turn, will push yields higher across the entire bond market and create upward pressure on rates even as the Fed is trying to lower them. The result? A steepening yield curve, where short-term rates fall but long-term rates rise. This dynamic will affect everything, from bonds to stock prices. The financial system is about to experience a massive shift, and understanding how these two forces, interest rate cuts and debt refinancing, interact will be crucial to positioning yourself for the next 18 months. Let's talk about Carol. Carol is a retired school teacher who has worked hard over the years and now has $400,000 sitting in a money market fund. For the past several years, this money has been earning her a decent return, around 5%. But now, thanks to the Federal Reserve's rate cuts, she's only making about 3.8%. While this doesn't seem like a huge drop, it's actually a significant loss. If the current trend continues, Carol's income will decrease by $10,000 per year without her touching a single dollar of her principal. This scenario isn't unique to Carol. There are millions of people with money parked in similar funds, and when you aggregate it across the $6 trillion sitting in money market funds, the picture becomes clear. What happens when everyone, like Carol, is forced to move their money at once? That's a massive wave of capital moving through the financial system, and it will cause a ripple effect in every market, from stocks to bonds and real estate. Moving too late could mean losing out on a significant opportunity. The key here is to see the shift coming before it happens so you can position yourself wisely. The obvious move when interest rates start to fall is to invest in long-duration bonds or real estate, right? After all, these assets are supposed to benefit the most when rates drop. But there's a hidden trap in this strategy: duration risk. Let me give you an example. Imagine you purchase a 30-year bond when rates are low, thinking it's a safe long-term investment. But then, unexpectedly, inflation picks up or the Federal Reserve hikes rates again. The value of your bond could drop dramatically, and suddenly you're holding a losing asset for decades. If rates rise by just 2%, a 10-year bond could lose 18% of its value. It's not an unlikely scenario, especially given the supply pressure from the Treasury. So while long-duration bonds and real estate might seem like the right choices in a falling rate environment, they carry significant risk. A better alternative: shorter duration bonds and dividend stocks. These assets are better positioned to handle the current environment, providing yield without exposing you to the duration risk that comes with longer-term assets. The obvious moves can be the most dangerous, and understanding the underlying risks is critical to making the right decision. Timing is everything when it comes to investing. Studies have shown that many investors underperform because they don't get the timing right. They buy after confirmation of a rally and sell into weakness. It's not about picking the right assets, it's about buying and selling at the right moments. Vanguard's research highlights that small differences in timing, buying too late or selling too early, can lead to massive long-term wealth gaps. For example, a $200,000 portfolio could lose around $530,000 over 30 years simply from poor timing. That's not from market crashes or bad stock picks, but from emotional decisions like panic selling or chasing after the latest rally. This is a major issue because human emotions, fear, greed, and impatience often drive irrational decisions. If you want to succeed in investing, you need to be mechanical, removing emotion from the equation. It's not always about making the perfect move, but about staying patient, disciplined, and strategic, regardless of what the market does. Now, let's turn to the great wealth transfer that's currently underway. Over the next 20 years, $84 trillion will be passed down from the baby boomer generation to their heirs.
This is a game-changing amount of money. And it's not just about the dollars moving. This transfer will change the entire structure of the financial markets. Baby boomers have typically been conservative investors, favoring stocks, bonds, and other traditional assets. But millennials and Gen Z, who will inherit this wealth, are much more likely to invest in riskier assets, such as private equity, real estate, and even cryptocurrencies. This shift in asset allocation will drive demand for alternative investments like technology stocks, real estate syndicates, and digital assets. So the generational shift will not only affect the wealth of individuals, but will also fuel growth in sectors that are already being shaped by technological advancements and new asset classes. Understanding this wealth transfer and its impact on market dynamics is crucial for positioning yourself in the right assets. Let's look at Marcus, a 44-year-old investor who's been following the typical advice. He maxes out his 401k every year and invests in a target date 2045 fund. Marcus has $320,000 in his 401k with a mix of stocks and bonds. But here's the issue. A significant portion of his bond allocation, about $32,000, is in long-duration bonds. With rising yields and supply pressure from the Treasury, Marcus's bond position is at risk of losing value. A 1% rise in rates could result in an 8 to 9% loss on his bonds, translating to a potential loss of $2,500. That's a significant blow to a portion of his portfolio that was supposed to be the conservative, safe part. So what can Marcus do? A simple move would be to shift part of his bond allocation into a short-duration bond index fund. By doing so, he could save anywhere from $8,000 to $25,000 in potential losses over the next few years. It's a small adjustment, but one that can make a big difference in the long run. Artificial intelligence is a game changer in the world of finance. It's improving productivity in areas like software development, customer service, and financial analysis. But here's the catch. AI's impact is concentrated in just a few companies. The top players in the AI-driven market, especially in the tech sector, are poised to capture the bulk of the productivity gains. But these companies already dominate the major indices like the S&P 500, so investing in broad index funds may expose you to a concentrated bet on just a few firms. If these companies face regulatory pressure or experience a slowdown in their growth, investors could see their portfolios take a hit. While AI has the potential to boost productivity, it also raises risks for investors relying too heavily on a small group of tech stocks. If you're heavily invested in tech, you may be missing out on diversification and exposing yourself to too much risk in the event of a sector-wide downturn. Over the next 18 months, we're going to see massive changes in the financial markets. The Fed's rate cuts, the U.S. Treasury's massive debt refinancing, the generational wealth transfer, and the rise of AI are all forces shaping the future. But it's not enough to just be aware of these changes, you need to act. First, take a look at your portfolio and identify assets that will benefit from the rate cuts, like short-duration bonds and dividend stocks. Also, check your 401k fees. If you're in high-cost funds, consider switching to cheaper options. A simple adjustment, like moving to a lower-fee fund, could save you hundreds of thousands over the long run. The key is to understand the terrain, make small strategic adjustments now, and position yourself ahead of the flow. By doing so, you'll be better prepared for whatever the next 18 months bring.